Welcome to the Savvy Commercial Real Estate Podcast, your resource for relevant, helpful, and immediately usable information regarding all things commercial real estate. Whether you are buying, selling, financing, exchanging, managing, or developing commercial real estate, rest assured you are in the right place. Savvy Commercial. Listen, apply, repeat.
And good morning, everyone. This is Neil Sherman. Thanks for joining us for our Savvy Commercial podcast. My guest today is Christian Sarver, Business Banking Team Lead at National Bank of Arizona. Chris has 25 years of banking experience and focuses on the banking and lending needs of small businesses. Chris joined National Bank of Arizona in 2016, already highly experienced in the small business space. He graduated summa cum laude from Arizona State University with a Bachelor of Science degree in history and also has an MBA from Grand Canyon University. Today we'll be speaking with Chris about the Small Business Administration, or SBA as it's commonly referred to, and there are various lending platforms available. Chris, good morning. Thanks for joining us today.
Hey, thanks for having me. Good morning.
We had a guest on several months ago who was speaking about commercial financing on, mostly apartment buildings, shopping centers, commercial properties. And shortly thereafter, well, probably for the next month or two thereafter, I had a number of people reach out to me and said something like, hey, great episode. How about getting a guest on there to speak about SBA loans? And, my previous guest didn't speak about SBA loans. We never really talked about it. It wasn't even on the agenda, so to speak. And then I got a second request and then a third request. So by the time I got the second and third request, I thought, okay, this is a topic that I need to get a speaker on to talk about. And you're that guy. So Chris, again, thanks for joining us. To give us a quick overview of the SBA and, just a simple explanation of how they work with select lenders and so on, can you tell our listeners about, National Bank of Arizona's relationship with the SBA and how the overall program works, if you don't mind?
Sure. Yeah, absolutely. So SBA, obviously the Small Business Administration, partners with quite a few different styles of lenders to basically provide capital to business owners to grow, expand, purchase real estate, equipment, buy businesses, working capital, lots of different loan programs, and lots of different folks that facilitate those loans, starting all the way at one end with, a kind of small business development companies and CDCs, which we can kind of talk about acronyms, and I'll try to use as few acronyms as possible. I know that as bankers, we get a little heavy on the acronyms, but so community development corporations, which do some form of SBA lending. Then you have non-traditional bank lenders that do SBA lending and are authorized to do that. And then you have your typical bank lenders that do SBA lending. Within the bank sector, and really any of them, the goal is to get to become a preferred lender, which means the SBA, you're tagged as a preferred lender for the SBA. So your guidelines are very much in sync with their lending guidelines. And National Bank of Arizona, I should say, is a preferred lender. So we offer really all of the SBA programs.
Okay.
I think I was going to say there are, a couple different programs and we can kind of expand on that. But I think that there are really only three that we talk about quite frequently here in my world, and that's the SBA Express, the SBA 7A, and then the SBA 504 program. So those are kind of the three biggies.
Okay, thank you for that, Chris. And before we get to that, and we definitely want to hear about those three. Before we get to that, and like probably many of our listeners, my particular knowledge of SBA loans, for the most part, consists of I'm sure you've heard this dozens of times. You can get financing up to 90% if the borrower occupies 51% or more of the building. So, I've heard that for, 15, 20 years maybe. when you do hear something like that, are they referring to a specific SBA loan program, or is that something that all the loan programs share? And if at this point you want to talk about the different loan programs, you could do that as well.
Yeah, that's a great lead in. So when they say 90% financing, as long as they're 51% occupant of the building, you're typically talking about one of two programs, either the SBA 7A or the 504 program. And those are the two that are used in conjunction with real estate purchases. And so in that kind of, very brief description of what an SBA loan is kind of the popular thought. And it does provide that. It does provide up to 90% financing on a building if you occupy 51% of the building. So critical with the SBA, and we can talk about all of the different loan programs, but one of the key critical pieces with SBA is that the person borrowing the money, the operating entity, is going to do business out of that specific location. So great program for people that own a business and want to buy either equipment, real estate, or want to just purchase a business or need some operating capital. But it is really designed to help businesses grow and employ folks. So it doesn't work for things like purchasing investment real estate that you're just going to lease out. The SBA is not a good fit for that, because it really is, the goal is, again, to create jobs, to create a business, to create something that's adding to the community is the idea.
Okay.
So within that, there are a couple different programs. As we talked about, the 504 is going to be only really used for real estate purchase. And that one's a little more complex because you have the bank doing a portion of the lending, 50% usually of the lending. Then you have a CDC or a community development corporation, which is kind of the SBA folks in that transaction. They're doing a loan for 40% of the total ask, and then your borrower adds 10% in. That's the 504, and that really only works for real estate. It can be used in some cases for equipment, but it can only be used for equipment that's really pretty expensive, and more importantly, has a useful life of like greater than 25 years. So again, 504 typically used on real estate. 7A is the other really popular SBA loan program, and that one is kind of a Swiss Army knife. It's used for a bunch of different things. It can be used for real estate purchase. It's a great tool for that. It's often used for working capital or long-term working capital. It's used to buy equipment. It can be used just to do a purchase of a business. So if you have somebody that wants to buy a business from somebody else, oftentimes that's done through an SBA 7A. So it's kind of our, again, it's a loan that can be used for a lot of different things. So the SBA 7A is really, really popular. And then the other loan that we typically do here at National Bank of Arizona would be SBA Express. And that provides a smaller guarantee, and we can kind of go into details about what a guarantee means. It provides a smaller guarantee, and we usually typically use that as to do revolving lines of credit is typically what we do on SBA Express. And the SBA Express has a much lower threshold as far as maximum, I should say, not threshold, but maximum loan amount. So it typically works well on lines of credit. Now, over and above those three, which are typically offered in a bank, there are a couple of other little loans. There's an SBA micro loan, and then there's an SBA Community Advantage loan. And those are typically done by those small business development centers or CDCs or community development corporations. So those loans are really targeted at the brand new startup businesses that have very low loan requests. So if you just need $50,000 to get off the ground or $10,000 to get off the ground, those micro loans or community advantage loans are a good fit. Okay. So those are kind of the major programs through the SBA.
Well, thank you for that, Chris. So, as always, I do my own preparation for these episodes. So I went online and I found what was referred to as an SBA loan fact sheet. I saw two things on there, one that you've kind of touched on already, but I saw the Small Business Jobs Act of 2010, and I also saw CDC. none of which I was very familiar with. So I realize it's been 13 years since the Small Business Jobs Act of 2010. So can you first tell our listeners if that still has any, if that program is still significant in today's market? And if so, how so? And then also, can you expand just a little bit on CDC? You said that stands for Community Development Corporation, was it?
Yep. Yeah, absolutely.
Okay.
So start with the Small Business Jobs Act of 2010. So the SBA has standard operating procedures, they call it, or SOP, and that's updated yearly. So their changes are made every year. But back in 2010, with this Jobs Act, which helped the SBA grow the loan size. And when I think back to that, the most critical thing was the jump in the maximum loan amount. It used to be as low as 1.5 million on 7As or 2 million on 7As, and around 2 million on 504 loans as well. That's grown to over 5 million now. So now you can do SBA loans up to $5 million. So the critical takeaway, I think, from the Jobs Act was just the increase in loan amount. And the design behind that is, let's lend more money to businesses so that they can employ more folks, add more jobs, add to the community, add to their, the economic development of the communities they serve. So that's probably my takeaway anyways. The critical thing with that was just the increase in the SBA loan size. Okay. As far as CDCs are concerned, so those are your folks that are typically going to help bank lenders on the 504 loan. And that, I'll kind of go through that again. The 504, as I said previously, that program is used typically to buy real estate. And where the CDC comes into play is that they're your lending partner on the transaction. So the bank will do let's say that, your borrower's going to purchase real estate, and it's a $1 million purchase, just for round numbers. So the bank would do a 50% loan to value loan on that real estate. The CDC would come in and do a 40% loan to value loan that ultimately is funded through a debenture, which is an investment, but it works like a loan to the borrower. And then the borrower would have 10% in. It's a little more complex transaction in that the bank funds the 50% loan to value loan right away. Then they fund a bridge loan for the 40% loan to value. And then that is ultimately taken out by the CDC and their debenture. But you're underwriting the transaction together. So you're getting approval through the bank, you're getting approval through a CDC, and then ultimately you're closing together and then sending the bond out for funding. So that's how those transactions work. And I know that's a really brief kind of description, and it can be a little bit complicated, but the value of that is that you're providing clients, an opportunity to have for that debenture portion, fully amortized loan that can be paid back over 25 years. And typically at a pretty competitive rate. So that's kind of the advantage of that loan. From a banking perspective, the advantage is that ultimately the bank ends up with a 50% loan to value loan. So, as far as collateral is concerned, the bank's in a great position in that, they have a 50% loan to value loan out there. And that portion of the transaction is priced like a conventional loan in banking terms. So it would, you would have terms of, depending on the bank and what their comfortability level are, you typically have terms where the loan's good for anywhere between 5 and 15 years, but the payment's amortized out over 25 years. So that's kind of how a 504 all works together.
Okay, great stuff. Thank you. Chris, let's kind of pivot a little bit to interest rates. We haven't talked much about interest rates. So if you were to compare an SBA loan to, say, a conventional apartment loan or a shopping center loan or industrial building loan, what have you, for an investor, how would those compare? Are SBA rates higher, lower, the same?
Good question. So partially dependent upon which SBA loan you're doing. I'll start with the 7A loan, which can be used for real estate, but it can be used for a variety of other things. That loan is priced on prime. So it's typically prime plus a margin of some kind. So 7A loans are typically rate-wise more expensive than a typical conventional loan. But again, the SBA loan provides for a lower cash injection, right? You can have only 10% cash in. It also is a great program when a loan request lacks traditional collateral or tangible collateral. Oftentimes we'll use an SBA 7A when you have a business acquisition where the borrower is buying a business from somebody else, and a good portion of that value is blue sky or goodwill. So that's where the SBA comes in, and typically the SBA 7A on loans like that give us a longer repayment period than traditional financing. So that's all to say that SBA loans, the 7A side, typically more expensive than conventional financing as far as rate is concerned. On the 504, it would be very similar to conventional financing because you're going to end up with, again, that 40% loan is going to be at the debenture terms, which typically are similar to that of what you would find in conventional financing. And then they are going to have a 50% loan to value loan, which would be a conventional loan in commercial terms. So you're usually pricing those on an index like the Treasury, the constant maturity Treasury, or something like that. And that's typically lower than prime. So those rates on the 504, especially when you blend the two rates together, typically end up being very similar to what you could get conventionally.
So Chris, with loan to value or loan to cost, is everything in the SBA world at a higher loan to value than in the conventional world? Or are you going to have situations, and you may have already touched on this, but are you going to have situations where those LTVs or loan to cost percentages are going to be very comparable?
Good question. So there are a couple things with the SBA to kind of dissect too that are a little bit different than the conventional side as far as loan to value or loan to cost. With the SBA, you end up creating a project cost for each loan or loan situation, where it's a little bit different in conventional financing. You want to go buy a building, you say, hey, I want a $2 million building. We say, great, you need to have 20% down and we'll finance 80% loan to value, and the fees and anything that's additional that's associated with getting that transaction closed, you're going to need to have that in cash. So the appraisal costs, the environmental costs, the title, those are all paid outside in cash, in addition to your 20% down. Whereas with SBA loans, the 7A and 504, you can create a project cost where you say, well, the building's going to be $2 million, but we also need, money for the appraisal, and we need money for the title. And so you can create one project cost of, let's say, just for round numbers, $2.1 million. And then the borrower would only need to have as little as 10% into that transaction. So there are a little distinction in how it's figured with SBA lending. And that also, SBA lending often is used when we're going to have some tenant improvements, and we kind of talk about that, or construction costs. We kind of talk about that in more detail. But it can be as little as 10% down. I think that it's not fair to say, hey, every SBA loan only needs 10% down, because you'll have some guidelines that require, specifically on the bank side, where we want more than just 10% in. If it's a special use property and it's a startup, well, we may say we're more comfortable with you having a 15% cash injection as opposed to 10. But the kind of overarching thought process is I only need 10% down on SBA lending, and that is pretty accurate in most cases.
Okay. Chris, let's just pause for a minute and give you an opportunity to share with our listeners, repeat your name again if you don't mind, and give us a phone number and an email address where people could reach you if they want to, ask more questions or have a particular need.
Yeah, sure. Christian Sarver with National Bank of Arizona, or Chris Sarver. My phone number, my office number is 602-952-4638. And then my email address is christian.sarver@nbarizona.com.
Thank you very much, Chris. And if you need to send me an email, again, my name's Neil Sherman. You could just send that to info@savvycommercial.com. Chris, getting back to it, let's just stay with the 602 number and National Bank of Arizona and so on. Two quick questions. Number one, is everything that you're talking about going to be the same, whether the property is in Arizona, Tennessee, Georgia, Florida, Chicago, et cetera, Las Vegas. SBA is a federal program, correct? So basically everything you're sharing, with the exception of the fact that National Bank of Arizona might not be the lender per se, but the program itself and everything you're sharing about 504 and 7A and so on, that's a federal program. That's going to be the same all over the United States, correct?
Yeah, it should be the same all across the country. If they're doing an SBA 7A loan, it should be an SBA 7A loan, whether you're in, Arizona or California or, back east, Florida, it shouldn't really matter. Same with the 504 program. Now, it can be a little bit different in that each bank also has their own underwriting guidelines. So you could have a bank that, say, is comfortable doing everything at 10% owner injection, whereas another bank would say, hey, we're not comfortable with going all the way down to 10% owner injection. We'd like to have 15% owner injection for specific products or transactions. But the programs and most of the guidelines should be similar no matter what institution you're talking to.
Well, again, just to extend that answer a bit, or maybe that question. So it's a federal program, but what other states would you consider looking at? I'm assuming this is going to be based on the state where the property is located, probably more so than where the borrower is located, right? So what other states would you consider looking at the business proposition, whatever the loan request might be?
So with us, we're a regional bank based. We're National Bank of Arizona here in Arizona, but we're owned by Zions Bancorp, which we have an affiliate or a presence in really all the states west of Texas. So if it made sense and our borrower was in Arizona, but they were expanding operations in one of the other states that we have a footprint in, Colorado, Nevada, Utah, California, Oregon, Washington, Idaho, Texas, New Mexico, I think that's covered them all. We would consider the project then. If it was a project for a loan for a property in Florida, I'm not sure that my group would have interest, just because we're it's not within our footprint. It gets to be kind of outside of the area that we would service. Okay. But if you got a deal in Florida, there's all banks, most of the banks should be offering SBA lending. So you should be able to throw a rock and hit a bank that'll do an SBA loan in every state that you're in. So
okay, and just one more time to tag on to that same question, if somebody contacted you regarding a property in one of those states, but they didn't need an SBA loan and maybe they needed more of a conventional loan, would you be the right person to speak with? I mean, Zions Bank is huge, obviously. Would you be the right person to speak with, or would you refer them to somebody else within Zions Bancorp? How would that work?
Again, good question. It would largely depend on the transaction and whether or not it made sense. If there was a reason for me to be the banker or my group to be the banker here in Arizona, if it was an expansion to another state, we would have interest. If it was just, hey, somebody reached out to me and they have a business in California and they want to buy a building in California, I would make a referral to some of the folks that I know at California Bank and Trust, which is our sister bank in California that would take care of them. So it would be more about whether or not I could service them correctly from Arizona. We're a relationship bank, so it wouldn't make sense for me to have a client that is only in some other state where I'm not really going to have a relationship with them. So that's a pretty long answer to a relatively short question. But if they're going to have some operations in Arizona and an ability for me to service it correctly, then I'd be happy to do it. If not, we have great partners in all the states that we do business in. So.
Well, you just got me thinking about another question that hadn't even dawned on me until your answer just now. If somebody is getting an SBA loan through National Bank of Arizona, and so you're a commercial bank, Would you require or just request or just like to have the deposit account as well, or is that a requirement of the loan? And along those same lines, do you need to set up some sort of an auto debit feature, if you will? I'm calling it an auto debit. That's probably not what you call it. Where whether there's a deposit account or not, the money to pay for the debt service on the SBA loan is being swept out of their account, whether that account is with NBA or not?
Yeah, good question. So, not a requirement of SBA lending to have a banking relationship with us. So you could have an SBA loan with us and not bank with us. That's not really our style. So we'd like to bank you. We'd like to think we can take good enough care of you that you'd want to bank with us, but not a requirement. As far as auto debit or auto payment is concerned, also not a requirement, but certainly makes it easier. We'd be happy to set it up from your National Bank of Arizona account, or if you have an operating account with another institution and that works better for you, then we would do that as well. We can make that auto draft setup as well.
Okay.
So none of them requirements, but certainly, as I said earlier, we'd love to bank you. If you want to borrow money from us, I'd love to have your deposit relationship as well.
Okay. All right. So I'm just going to take us back to a previous question before you gave your contact information, if you don't mind. You were referring to what I believe would be called soft costs. I'm talking about an appraisal, maybe some third-party reports, et cetera, et cetera. Let's talk about some hard costs. So I think you used a $2 million example. I'll stick with that. So it's $2 million to buy the building. They're going to be occupying 51% of that space for their business. And they have an appraisal. They have some third-party reports. But let's say they also have, I'm going to make this up, $250,000 of repairs and replacements. Let's call it HVAC, roofs, parking lot, what have you. And then just to beef this up a little bit, they need $250,000 for FF&E or furniture, fixtures, and equipment to go inside the building. And then last one for good measure, I'm probably stretching on this, but another $250,000 for upfront working capital, right? There's $750,000. 500 of it was for what I would call hard costs. That last 250 was for working capital. How does that factor in this whole thing? So you still have the $2 million building. Is this still something that the SBA and National Bank of Arizona would look at?
Yeah, in fact, that request that you just kind of described is really nicely in the fairway of an SBA product. As I mentioned earlier, the SBA, we can create what we call project costs rather than just purchase and loan to value. We can have a project cost where we say, yes, the building is $2 million, but we have $750,000 of these additional costs that go with this purchase of the building. So we really have a project cost of, 2.75 million. That's great. The SBA is a great program for that. They would help with the construction budget. We would create it. It becomes complex, and we create what we call a sources and uses worksheet where we have the source of the funding, either the cash injection or the loan, and then the uses of that funding, to purchase the real estate, soft cost to the architect to draw up the plans, hard cost to the general contractor that's actually going to do the build out. And then, working capital, or even we can even build some stuff in there to help with the carrying costs while the construction is going on. We can have a contingency budget and some carrying costs built into that kind of project cost, which helps with the ability of a business to get a building purchased, get it renovated so that it works for their use, but then also not totally crush all of their working capital getting into it. And you spoke of, what about a working capital portion of that? Absolutely, we could do a working capital as well. We may have to get to a blending of the repayment periods because we don't want to finance working capital cash for 25 years. We would want that paid back over a much shorter period of time. But absolutely, you can create a project cost and help your borrower get everything they need to get the building to where when they occupy it and want to start operating, they're ready to go.
Well, the piece I left out of that question, I realized after you started giving your answer, for the borrowers out there, I'm sure they're already thinking this. If you had already approved the building purchase at 90%, let's say, and there's another $750,000 in this example I used, are we still at the 90-10? So that $750,000 will cost them another $75,000? Or I understand payment or payback terms have to be blended and all, but what about the upfront cash? Are we still talking 90-10 on that extra $750,000?
Yeah. You can still get it to where you have, a project cost of $275, and you would need to have, instead of having, whatever it is, 10% of only having 200,000 in it. Now we need you to have, $275,000 into the project is your 10% injection. So,
okay.
It still does absolutely work that way.
Okay, great. Now we're down to probably our last few questions for you. I've been taking notes, so some of the questions I had for you I've now crossed off because you've answered them. But I think this one probably needs to be asked and answered, and that is for our borrowers out there, or potential borrowers out there, are the underwriting requirements for either the property or the business or a combination of both, or the borrower, for that matter, the person, are they typically going to be more stringent or less stringent when it comes to your SBA financing versus, say, like we talked earlier, a conventional loan on an apartment building or a shopping center, which I understand they're going to be putting more down. But what about how you underwrite the property, the business, and the borrower? Does that change at all as compared to a more conventional loan when you're dealing with SBA financing?
Yeah. So the short answer is yes. I had an instructor in a lending early in my career in commercial lending class tell me that SBA doesn't make a bad loan good. It just helps get a loan done that is maybe missing a piece for conventional underwriting, from a conventional underwriting perspective. So yes, the guidelines for SBA lending can be more relaxed than what you would see on a conventional side. As we've talked several times, the loan to value is obviously higher, right? You have less cash into the project. We are a cash flow lender, so it still has to cash flow. So we're not going to do an SBA loan if it doesn't cash flow, but it does provide that SBA guarantee does help in situations where conventionally you could not get approved. Great example is time in business. Most conventional underwriting we want 2 solid years of financials. So you need to have been in business for 2 years. With an SBA, that's one of those things that SBA is great for. We can do a loan for a business that's only been in operations for a year. We could do a loan for a business that hasn't even operated yet. It's an SBA 7A loan for startup costs. So that's one of those key things that absolutely wouldn't work in conventional financing, but works great from an SBA's perspective.
I loved your answer, and I didn't mean to step on what you were saying, but I started writing that, and I didn't get it all, but I love that answer. The SBA doesn't make a bad loan good. It just does what? Can you repeat that again?
It just takes care of, it just provides a mitigant to maybe an aspect that makes it not work conventionally. So again, it doesn't make the loan a bad loan good, but it provides mitigation for one of the conventional underwriting guidelines that we may have that this borrower can't satisfy.
Okay, go ahead. And I'm sorry, I cut you off. You were saying?
No, I was just saying that SBA is that's what SBA works great for, is to help with we was talking about the 5 C's of lending, character, capacity, all those things. And SBA doesn't take care of character. It doesn't really take care of capacity because you have to have cash flow. But it can take care of some of these other things that a borrower may not have: time in business, cash flow or cash injection into a project. Maybe they don't have the experience that you want for that specific project. Well, the SBA is a great tool then. So
Chris, let's talk about repayment periods. You might have touched on this a little bit, but are we talking 10 years, 20 years, 30 years? With conventional loans, say on an apartment building, you might even have a fully amortizing loan, or on a lot of commercial loans, they come due in 5, 7, or 10 years. How does that work in the SBA world?
Good question, Neil. So dependent upon the collateral oftentimes and the program. So I'll start with 7As. With an SBA 7A, if we're not using real estate as collateral, so if it's not for a building purchase, typically the max amortization and term is 10 years, so 120 months. So that's pretty typical. We use that for working capital, or if somebody's buying a business, that's kind of the max term there. Now, with a 7A and a 504, if you are, which 504 has to be real estate, but if real estate is involved in either of those transactions, on the 7A side, we can go 25 years fully amortized. So the term is 25 years, amortization is 25 years. On the 504, it's a little more complex because, as we discussed, the 504 is a blend between conventional financing when the bank has a note for 50% loan to value, and then that 40% debenture. I'll start with the debenture. That's the SBA portion. That one is fully amortized, typically over 20 or 25 years. The conventional financing portion of that 504, that 50% loan to value loan, is not typically the amortization period will match what is offered by the SBA, but the term will not be 25 or 20 years. It's typically 5, 7, 15, 10, depending on what the bank offers. But traditionally, most banks offer either a 5, 15, or 10-year term on that side. So a little complex in that you can have different terms depending on the product, but know that on anything real estate secured, you're really working on a 25-year amortization for both the conventional side and the SBA side. If it is just a 7A loan, then again, 25 years fully amortized.
And I hear you talk about the amortization periods, let's say the 25-year fully amortized. What about interest only? Is there any IO in these loans? Either do you offer that, or if a borrower requests that, will you accommodate that? If it's not part of the normal SBA program, will you accommodate an interest only request? And if so, for how long?
Yeah, so good. Yeah, good question. Good follow up. Absolutely. Oftentimes we see the interest only request on startups or specifically construction related projects. So if you have a building that you're purchasing, let's just say you're going to use a 7A to purchase a building, but you've got $250,000 worth of tenant improvements or construction. Oftentimes within that project cost, we'll build out an interest only period while the construction is going on. Typically that can range from 9 months to even up to 18 months, depending on the scope of the project. But more importantly, in addition to the interest only, we can build in some reserves to make that payment while that construction is going on. So what the borrower is paying while the construction is going on is really nothing, because we built some reserves in the loan amount to pay that interest only payment while that construction is going on. So the short answer to your question is absolutely, we can build in some interest only period, but even further than that, we can build in a cushion to help make that payment while the business is getting the building up and running and doing the construction.
Got it. Okay. And Chris, just in case any of our listeners are pondering this question like I am. So again, the SBA is not loaning the money, correct? In this case, National Bank of Arizona is actually loaning the money, right? It's your money. The SBA is more of a guarantor or something that, or an insurer or a guarantor, but not the actual lender. The money's not the SBA's. The money in this case would be National Bank of Arizona, correct?
Correct. Yeah. So the SBA is just providing an additional guarantee on the note. So they're, an insurance policy, for lack of a better term, specifically on the 7A portion. On the 504, it's a little bit different because the bank's doing their note for 50% loan to value, and then a CDC, which is a Community Development Corporation, is doing that SBA portion for 40%. And then that money is actually then that note is actually a debenture bond that's sold. So it's like an investment that's sold. So the SBA is really not funding these notes. They're more of just kind of a guarantor on them, is kind of the short, quick answer. So the bank is funding.
Okay, then so is it safe to say that if a prospective borrower calls the SBA about an SBA loan, the SBA is going to refer them, if they even do this, they're going to refer them to an actual SBA lender like National Bank of Arizona. They're not going to say, oh, sure, let me transfer you to John who handles SBA loans. They're not making the loan, so they have to refer them back to an SBA lender.
Yeah, so yes, great clarification. Yeah, they're going to typically refer that request back to a preferred lender in whatever market that borrower is in, with one exception, which is, and this is a loan that we haven't talked about, but the EIDL loan or EIDL loan, which is the injury disaster loan that the SBA put out like during the pandemic or when there's a hurricane or something like that. The SBA is actually funding that loan, but that's a totally separate loan. That's not used for, that's all a, kind of an aid thing. So that's not one of the standard loan products that we're talking about. So I don't want to create confusion, but that's, if you ask, is the SBA funding anything? No, it's typically the bank or alternative lender or community development corporation or small business development company that is actually providing the funding. The SBA is just there with their program to guarantee it.
Okay, good, understood. I just have a couple more questions for you. I'll try to make them brief. I don't think we talked about this, and if we did, I don't see it in my notes. Are these recourse or non-recourse loans? So recourse, I'm sure the people listening would know that recourse, there's a guarantee, and you can look, past the loan amount, the actual loan, to other assets, versus non-recourse, which would be limited to the loan. Correct? So, are you getting personal guarantees, and if so, how does that work?
Great question. Yeah, so all of your SBA lending is going to require a personal guarantee for any owners that own 20% or greater of the business. So, and these are typically unlimited guarantees. So if you are a 20% owner and the business borrows $1 million, you're not on the hook for 20% of that borrow. You're on the hook as a personal guarantor for the entire borrowed amount. So they're unlimited guarantees. So all SBA lending is going to require a personal guarantee. So they're all full recourse.
Okay, and I said earlier on the non-recourse, it's limited to just the loan, but I guess I should have said the loan amount. Whereas, really on a non-recourse it would be limited to the collateral probably. Whereas on a recourse, it's not just the collateral, but any and all other assets that they may have to take to satisfy the loan balance, what's left, right?
Yeah, and that's a good distinction because there's kind of a pecking order in how loans are repaid, right? So first source of repayment is cash flow from operations, and then we get to liquidation of collateral, then we get to, in these full recourse loans, then you get to assets of the guarantor, and then finally, once all that's settled, if the bank is still out in the wind for any portion of that note, then that's where that SBA guarantee would kick in, up to a percentage of the loan amount.
Oh, see, I didn't know that. So they have to exhaust all other efforts to get repaid before the SBA component kicks in, the guarantee component. Interesting.
Correct.
Okay. Well, Chris, we're pretty much done with my questions, except I do want to put you on the spot just a bit. And this is your own personal opinion. This isn't the opinion of National Bank of Arizona or the Small Business Administration. I just want to hear your take on this. When it comes to the business types that, or the people that are coming to you for these loans, they're gonna have a business in mind that they need money for, they need funding for. Can you tell me if certain business requests, funding requests, would be considered a little bit more risky on the part of National Bank of Arizona or the SBA, and if other business types might be considered less risky, and I'm guessing that the less risky ones are more likely to get funded, and the more risky ones are probably less likely to get funded, right? And if so, what are those businesses?
Yeah, absolutely. So I would start with we'll start with the SBA portion first and foremost. So the SBA is going to require that the business is an operating entity. So it can't be, an investment type thing. It can't be that you're going to buy a strip center and rent it out and collect rental income. They want a business that's operating, that's creating jobs, adding to the community that they serve. So that's first and foremost. It's got to be a for-profit business. Then you get to what are considered restricted industries, what are considered cautionary industries, and then what are kind of the fairway that all banks like, or specifically the banks that I've worked for like. So we'll start with restricted. Restricted are those that are either illegal to bank, or the operations are illegal, or they're too hard to trace for us to be comfortable with them. So some of those examples would be marijuana related businesses, sexually oriented businesses. Those are all internet gambling. All of those are going to be, restricted. It's just not something we're going to be involved in because of either the reputational risk or the, regulatory risk involved in banking those folks. After you get past that, the next group would be the folks we consider cautionary industries. That these are folks that, can we bank them? Can we do loans for them? Sure. Can an SBA loan be done for them? Maybe. But they're just tougher deals to get done. Some of those would be gas stations or C-stores, convenience stores. Those are difficult. Assisted living care facilities or memory care facilities, that's pretty popular one right now. Those can be more difficult to get done. Charter schools, those create a level of difficulty. Hotels specifically, or motels, specifically those that are not flagged or are not part of a brand. So if you have just a boutique hotel as opposed to one that's branded Holiday Inn or Marriott. So those are some examples of industries that we would consider cautionary. Restaurants is another big one that's considered cautionary just because of the compressed margins that restaurants earn, and then the percentage of failure, honestly. So those are all considered cautionary. The final step would be the folks that, are kind of in the fairway, the ones that are a green, they're a go. For me, I like wholesalers, manufacturers are great. Professional services, so CPAs, doctors, attorneys, those kind of folks are typically the easiest to bank. I'll go back to manufacturing because that one is one of those ones that, as a small business or commercial lender, those are popular because they need buildings, warehouses, they need equipment which we can lend on, they need operating lines of credit, and they're building a widget of some kind. So that those are companies that are great to bank. We'll do some construction lending, providing that they're not, spec home builders or something like that. But if you've got a big, painting contractor or drywall contractor, those are folks that we can bank as well. So those are some examples of, again, not National Bank specific or SBA specific, but, just kind of in my experience, those are kind of the three categories of folks that we find out there that we try to lend to.
And just to tag on, and great answers, by the way, just to tag on to what you just said, and this is for my own clarification and anyone else who's listening that might be thinking the same thing. Is there a distinction made between, for lack of a better word, a startup business and one that can point to, 5, 10, 20 years worth of a track record, financial statements, and so on? And on the startup side, what they lack in 5, 10, 20 years of track record, can that be offset by, a strong financial statement and the willingness, not the willingness because you said it's mandatory, to personally guarantee the loan? Will that offset it? That's just going to pick some of your sweet spots. You said, a doctor. I'm just going to use a doctor. Whether he's buying the building or leasing the space, let's say it's not a doctor who's been in business for 20, 30 years, but he's very strong financially and he's going to guarantee the loan. Might that strength, financial strength and personal guarantee offset a little bit the fact that he doesn't have the track record? Or is the track record gonna, no pun intended, trump everything and be more important than anything else?
Yeah, I would say there are some spots where strong personal guarantors fix a lack of history in business. But to kind of go back to the beginning of your question, so what's that kind of, when are you considered a startup versus, an established business? The kind of the baseline is 2 years of financials. So when you have 2 complete years of financials, then you can move away from SBA startup financing. And that's just to kind of circle back to our beginning of our conversation. SBA is a great tool for folks that are starting in business. So if you're a startup, it's going to be difficult to lend to you any other way than using some sort of SBA type lending, because that's one of those things that you just don't have the track record. You don't have the historical to underwrite to. So the SBA fixes those folks that have not been in business for 2 years, greater than 2 years. After you get in business for a couple, 2-3 years, then we can start looking at conventional options for you. But to back to your second part of the question, which is, can a strong personal guarantee help? Absolutely, especially when we're doing in small business lending and in SBA lending, we're oftentimes underwriting to a global cash flow, meaning, what cash flow does the business generate, and then what personal cash flow is there, and kind of adding that together, and then adding the personal debts and then the business debts together to figure out whether or not there's enough cash to service that debt. So absolutely, a strong guarantor can definitely make a loan much easier to get across the finish line.
Okay, great. Well, Chris, you've been a wonderful guest today. I appreciate your time. Your answers were very eye-opening, very informative. I know a lot more about SBA loans than I did before we started, that's for sure. I just want to repeat for everyone that if you want to get a hold of Chris, you can either call him directly at 602-952-4638, or you can send him an email at Christian, CHRISTIAN .Sarver, at NB Arizona, National Bank Arizona, nbarizona.com. If you want to get a hold of me, you can send me an email at info@savvycommercial.com. I'm your host, Neil Sherman. Our guest today has been Chris Sarver with National Bank of Arizona. Chris, greatly appreciated. Thank you for your time, and hopefully we'll get you on here again down the road.
Thanks, Neil. It was fun. Glad
Thank
to
you.
do it.
Take care. Bye-bye.
Bye-bye.